Imagine this. You're 18, fresh out of high school, and excited about college. But there's one thing nagging at you: money, textbooks, rent, maybe even that dream spring break trip. It all adds up. But what if I told you there's a way to make your money work for you, even while you're focused on hitting the books? That's the power of value investing and building a diversified portfolio. Buckle up, because in this video, we'll crack the code on building a portfolio that grows alongside your college journey, all with a long-term perspective. So, without further ado, let's begin. What is value investing? Let's rewind a bit. You might be wondering, what exactly is value investing? In simple terms, it's like finding hidden gems at a garage sale. You're looking for stocks, pieces of ownership in companies that are priced lower than their actual worth. So, how do you find these gems? Here's the secret sauce: research. We'll delve into that later. But for now, remember, value investing is about buying quality stocks at a discount, with the belief that their price will eventually rise to reflect their true value, making you money in the long run. Why value investing for college? College is a marathon, not a sprint. You need a financial strategy that keeps pace. Value investing shines here because it encourages a long-term perspective. You're not chasing quick wins, but building wealth steadily over time. This aligns perfectly with your college years. You invest while you learn, and your portfolio grows alongside your knowledge. Building a diversified portfolio. Now let's talk about that magic word: diversification. Imagine putting all your eggs in one basket. Risky, right? Diversification is like having multiple baskets for your eggs, each holding different types of investments. In the world of investing, this means spreading your money across various asset classes. Here's why it matters. Different assets react differently to market changes. When stocks go down, bonds might go up, helping to balance things out and minimize overall portfolio risk. It's like having a built-in safety net. So, how do you diversify? Think stocks, bonds, and even cash. Stocks offer the potential for high growth, while bonds provide stability and income. Cash gives you immediate access to funds and helps navigate market fluctuations. By strategically allocating your money across these asset classes, you create a well-rounded portfolio that's less susceptible to major market swings. Remember, diversification is key to building long-term wealth, choosing the right investments for you. Now, the million-dollar question: what to invest in? Relax. You don't need to become a Wall Street whiz. Here are some tips. Index funds. Think of index funds as pre-made portfolios, like a grab-and-go lunchbox for your investments. They hold a basket of stocks that track a specific market sector or the entire market itself. This is a low-cost, low-maintenance way to get started with investing. Since they mirror the market's performance, you won't outperform the market, but you also won't underperform it by a large margin. Index funds are a great option for beginners who want broad diversification without the hassle of picking individual stocks. Exchange-traded funds, ETFs. Similar to index funds, ETFs are like pre-built baskets of investments. But unlike index funds, ETFs trade throughout the day just like individual stocks. This gives you more flexibility when buying and selling. ETFs can track a variety of things like stocks, bonds, or even commodities, like gold or oil. They offer diversification and ease of use, making them a popular choice for many investors. Blue chip stocks. Imagine a company that's been around for decades, a household name you trust. That's a blue chip stock. These are well-established giants of their industry, known for their stable growth, strong financials, and consistent dividend payouts, like a regular allowance from the company. While they might not experience explosive growth, they offer a degree of stability and predictability that can be valuable for a long-term investor building a diversified portfolio. How to find value stocks. All right, enough talk. Let's get to the nitty-gritty. Finding those valuable stocks. Here are some tips. Research. 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 This isn't just a catchy phrase, it's the foundation of value investing. Think of yourself as a detective, piecing together clues about a company's health. Your tools, annual reports, news articles, and analysis from experts. Dig deep. Uncover the company's financial performance, its track record, and what sets it apart from the competition, its competitive advantage. The more you research, the better you understand the company's true worth. This helps you identify stocks that might be undervalued, hidden gems in the market waiting to be discovered. Remember, you're not buying a trendy product, you're investing in a piece of a business. So, research is key to making informed decisions about your portfolio. Think long-term. College is a time for late-night study sessions, epic friendships, and, of course, managing your finances. Value investing aligns perfectly with this long-term perspective. It's not about chasing get-rich-quick schemes or panicking over every market fluctuation. Instead, you're building wealth brick by brick. You focus on the company's fundamentals, its financial health and future prospects, and believe that its true value will eventually be reflected in the stock price. Think of it like planting a seed. You wouldn't expect a giant oak tree to sprout overnight, right? Value investing is similar. You plant the seeds of your portfolio with carefully chosen stocks, nurture them with research and patience, and watch them grow steadily over time. By embracing a long-term mindset, you avoid the emotional roller coaster of short-term trading and set yourself up for financial success well beyond your college years. Price-to-earnings ratio, PE ratio. The PE ratio is a handy tool for value investors. Imagine a stock priced at $20 per share, and the company earns $2 per share each year. The PE ratio would be $10. A lower PE ratio can sometimes indicate a potential value stock. It suggests the market price might be undervaluing the company's actual earnings potential. However, PE isn't the holy grail. A low PE could also mean a company is struggling to grow. That's why it's crucial to combine the PE ratio with other factors like the company's industry average, future growth projections, and overall financial health. By understanding the PE ratio and using it alongside other research methods, you can make more informed decisions about potentially undervalued stocks. Don't be afraid to ask for help. Investing can feel overwhelming, especially for beginners. But remember, you don't have to go it alone. A financial advisor is like a personal investment coach. They can help you navigate the complexities of the market, assess your risk tolerance, how comfortable you are with potential losses, and develop a personalized investment strategy aligned with your goals. Financial advisors aren't there to judge your knowledge. They're there to empower you. Don't hesitate to ask questions, discuss your concerns, and seek guidance. A good advisor will explain things in clear terms and work with you to build a portfolio that reflects your unique financial situation. Remember, knowledge is power, and a financial advisor can be a valuable resource on your investment journey. Patience is key. Building wealth takes time. Don't get discouraged if you don't see results overnight. The stock market can be volatile, with ups and downs along the way. But remember, value investing is a marathon, not a sprint. You're planting the seeds of your financial future and nurturing them with research, patience, and a long-term perspective. Focus on the fundamentals of the companies you invest in, their strong financials, competitive advantages, and potential for growth. Stay committed to your strategy and trust that over time, your portfolio will flourish. Remember, the knowledge and experience you gain now will benefit you not just in college, but for decades to come. So, stay patient, keep learning, and enjoy the journey of becoming a successful value investor. So, are you ready to become a college investor? With value investing and a diversified portfolio, you're setting yourself up for financial success. Remember, this is just the beginning. Keep exploring, keep learning, and most importantly, keep growing your wealth alongside your knowledge. Thanks for joining me on this journey. If you have any questions, leave them in the comments below, and I'll be happy to answer them. And don't forget to like and subscribe to our channel for more investing tips for young adults. We will see you in our next video.